Hello, everyone. Welcome back to another edition of Signal or Noise. This is episode 29. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, a lot of fun topics to talk about today. We're going to start off with a tweet of yours that went viral talking about cognitive biases, and we'll discuss some ways to overcome them. We're going to talk about 8 cognitive biases that investors all fall prey to. No one's immune to this, so this will be an interesting discussion. Number 2, the 401k contribution nudge. Interesting things going on in the 401k world in terms of what the setup is for employers. It used to be a much lower initial startup percentage, and today it's much higher. So we'll discuss whether that's a good thing and what that's doing to savings rates in the 401k world. And we'll end, as we always do, talking about signal or noise. A lot of extremes going on. I don't know if you've noticed, Peter, in markets. A lot of comparisons to March 2000, and we got a big one here talking about growth stocks versus value stocks at their highest relative levels since March 2000, the peak of the dot-com bubble. So that'll be a fun one. All right, let's start out with 8 cognitive biases and how to overcome them. It started out with your tweet here, and excellent breakdown of cognitive biases. A lot of people commenting on these, and I think the temptation is we read this, we think, well, if I understand what these are and I know about them, well, then I can avoid them, falling prey to them in terms of my own behavior and investing. And do you think that's actually the case, or does it prove to be much harder than that in reality?
I think the reality is most of us, no matter, even when we're aware of them, it's such a big part of human nature to cave into these. I mean, all of us do. It does help to be aware of them and to really be able to try to self-identify it. But I think it's incremental. And I think the reality is the cognitive biases drive the world. I mean, they're very, very powerful.
100%. So we'll try to give our best tips for avoiding them at the end of this, but let's start out breaking these down. Number 1, the anchoring bias, which is you're relying heavily on the first piece of information you receive. And we see this a lot in investing, and I'm sure you see this with clients. I think the best example, and you could pick any stock, they fall in love with the stock and they fall in love with the price that they entered into it. So if we buy a stock, this is the example here is Nikola. Right. They bought it during the 2020 boom. They heard a lot of good things. It was a hot stock, promising stock in the EV space, and they're anchored to that purchase price. And it looks crazy because it's over 2,000. But that's because this stock reverse split so many times since then. But they're hoping for that stock then to get back to that price. They're anchored to that price, and they're ignoring kind of all of the information, negative information that has occurred since that point in time. How do you talk people through this anchoring bias in terms of falling in love with the stock and ignoring kind of all evidence showing that it's time to sell this
Yeah, I mean,
position?
there's a saying that you can love a stock all you want, it's not going to love you back, right? And I can't remember who said it, but that's definitely true. But we are all married to whatever we buy in at. That just becomes some magic number. It's completely arbitrary, of course, because throughout the year it's got 1,000 different prices, but the price you buy it at, that's the price that all your psychology is tied to. If it's below that price, you want to stay in until you break even, right? You can hear all the listeners going, oh yeah, break even. Just like if you're at a table in Vegas, you're down, you are anchored to the dollars you entered with. If you started with $500 and you're at 300, you are thinking about getting back to 500. That's just human nature. But anchoring works the other way too. Like once you get to 500 at the blackjack table, if you're up to 600, 700, 800 is another bias, right? It's mental accounting where you start to feel like you're playing with not your own money, the house's money. It's not yours. You bought it at $500. Everything above it's not yours. So you're playing, not worrying about it. So this anchor is a killer because you're above it. You feel like it's not, you're playing with house money. If you're below it, you're playing to break even. This is why people hold stocks too long. They can't sell. They become too anchored to that price. And ultimately it goes up and down, but people have a hard time exiting. And most stocks over the long run are losers. That surprises people. But over the long run, most stocks lose because of the way capital destruction happens in a capitalist environment, constantly replaced by new companies. So anchoring, I love that you started with this one because I think it's the most powerful bias when it comes specifically to purchasing stocks.
Yeah, 100%. This is a kind of a good example for investors because there was so much information that came in after that mania phase in 2020 that where you would have said, hey, maybe something is different here in terms of my initial thesis. And with Nikola, there was a lot of accusations of fraud, and then it actually turned out to be true. And this was in, I think, September, October 2020, when it was kind of revealed that they did this video of one of their trucks supposedly powered by this EV technology, but they actually uncovered that they just rolled the truck down a hill, and this they made it look like it was actually using that technology, and it wasn't. And they slapped kind of the logos on there, and the founder of this company actually was convicted subsequently, and I think is serving prison time for it. But Peter, that was way back here in 2020. Yes, you would have taken a loss, but had you stuck with this stock and kind of ignored that information and ignored the fact that this company has never made a dime, it's barely produced any vehicles during this period of time, and it was trading at such a ridiculous valuation at that point in time, assuming that there was going to be just this massive production. All of that was ignored because of that anchoring position.
Yeah. It's killer component of investing, by far the biggest cognitive bias when it comes to the stock market.
And then we see it on the upside too, by the way. Like you're buying a stock or an index and you say, well, it can't possibly go higher and I'm anchored to that initial price and I don't want to add more. Well, the stock market tends to go up over time. So you better not have
Yeah.
that tendency to say, well, I got in 20 years ago, the stock market's so much lower. Well, today it's much higher. But yes, profits are higher. The economy and economic growth has been significant. So you can't look at it that way as well. Okay. Number two here, outcome bias. You judge a decision by its outcome, not the decision making process. And I want to talk about meme stocks here because we tend to focus on the negative end of things. And for most people, it does end badly. But for a lucky few, Peter, they'll jump into a meme stock after hearing about it and they might make a profit on it initially. And it could have nothing to do with the decision making process. Could be a terrible decision. And I'm looking at here a company called Faraday Future Intelligent Electric, another company in the EV space that hasn't really done anything, but it became a popular meme stock during the recent craze with GME and AMC. I don't know what the genesis of that, but somewhere on some message board somewhere said, this is the new meme, go ahead and buy it. And you can see here just the crazy advance that it had. It went from, I think, 5 cents to almost $4. And no doubt there were people in there who bought it at some point, sold it a few days later, and made a profit. And the outcome bias is saying that was a good decision. So therefore, I could do it again. It comes back down. I'm going to try to do it again. And then clearly that doesn't work out for
Yeah, I
them.
mean, you can tell. Let's go back to the casino. I mean, if you're teaching somebody to play blackjack, right, and the dealer has a face card, and the person you're teaching is showing a 6, you would tell the person showing a 6, you've got to hit. Okay, the odds. This isn't a great setup, but the odds are in your favor if you hit than if you don't hit. And they don't take your advice. They don't hit, and they win. The dealer busts. So they go, "Oh, I was right." That person wasn't right. They just got lucky, right? And you see the same thing with sports where someone makes a very, very bad decision, a low probability. You're going for it on, 4th and 4 on your own, 20 or whatever, at a time in the game when you're not supposed to do it, and you get a good outcome. That doesn't mean the decision was good, right? You really have to look at the process, not the outcome. This carries forward, just like you said, Charlie, into investing.
And the opposite could be true too for a period of time. You could have a good process and make
Yeah.
decisions based on a good process, and the outcome in the short run could be not so good, and you can question that, right? So it's not just a one way street here, but clearly that the fact that you got lucky on something like this, you shouldn't be saying, "Well, that's my skill. This is a good thing to do to buy a stock based on a meme." And when I tweeted out and wrote about this story of Faraday Future, of course, I had people emailing me, telling me, you don't understand the fundamentals of the company. So I said, well, let's look into the fundamentals of the company. And as it turns out, not so good. They've been losing money every single quarter. They barely have any revenue. It's like in the thousands, and they have about less than 2 million cash left, and lost $80 million last quarter. So the notion that this company is a going concern and that could possibly continue, absolutely not. And just ignoring all that fundamental data to say that I'm going to jump on this meme and it's a good decision, not so wise. So be very careful about the process that you're looking at and attributing what could be luck to skill. Number three, confirmation bias. You favor information that confirms your existing beliefs, Peter. This is enormous. We see this in politics, we see this in investing. And you could have a position, and there's something out there that can confirm that. So just sticking with Faraday for a second here, you're saying to yourself, well, I'm in this position. Let's say you bought it at the top and you're saying, I want to wait till it comes back. Well, I need to find some information to say that this is going to be a good situation for me. If you just do a Google search, Faraday future uh, is going to be a good stock in the future, this will come up very quickly. I found this article here. It's gaining momentum. It's the meme stock of the future. And you could do this with pretty much anything. And that's the danger of kind of living in that bubble and not seeking out objective information on both sides and just looking for the information that confirms your existing belief.
Yeah, I mean, politics, you mentioned at the beginning, politics is the best example of people that suffer from confirmation bias, which is almost everybody. So, for our listeners that are, very conservative, they might watch, Fox News, they might go online to the Drudge Report, or there's a bunch of sites, right? And then if you're pretty liberal, you're probably reading the New York Times, you're probably watching MSNBC and CNN. In other words, you're only listening to stuff you already agree with 100% of the time. And if you don't think you're susceptible to confirmation bias, think about the 5 hot topics for you. Maybe it's immigration, pro-choice, pro-life, taxes, all the sexual identity stuff. You've got opinions, right? All of us have opinions on all of this stuff. And are you open-minded at all to the other side of this debate? Or are you only watching things that validate what you already believe and say the other side are complete idiots? Is there any issue of the top 10 political issues? Is there any that no matter who, if we had a whole day of the greatest speakers in the world on the other side of the topic, giving you all of the reasons to take the opposing view of where you are in any of those 10 issues, would you change your mind about any of them? The answer is no, you're not going to, right? That's how incredibly powerful confirmation bias is. When you carry it over to the equity markets, Warren Buffett talks a lot about this. You buy a stock and you look for reasons to continue to own it. You rarely look for reasons to sell it. And really, you should be looking at the opposite. I can tell you at Creative Planning, when we're going to go buy something, whether it's a private equity fund or investment, public investment, we are looking at what can go wrong. Like, what are the things that can go wrong here? If this comes undone, how did it come undone? Is it the management team? Is it the approach? Is it what is it? And that's really the way you should look at your positions, not just when you buy them, but later. Ask yourself, why am I still holding this? Would I buy this today? What could go wrong? Devil's advocate is really kind of the next step of being a good investor.
Yeah, so having it's kind of related to the last one, having that good process going in and checking everything and make sure you're going through the due diligence and thinking about the downside and thinking about the other case that could be made. And the stock market's a perfect example because for every buyer, there's a seller, and you're selling to someone who might have more information than you. And what is their position? Why is someone selling you their Faraday future in this example? Why is someone selling you? It might be a benign reason, right? It might be okay. They need the money for retirement, a liquidity event, but it might be because they know more than you. And just ignoring that could be a very, very dangerous thing. Do you find in talking with people who come in, this happens a lot in creative planning, they come in with a concentrated stock position and they've done extremely well in this position, whether it's Netflix, Tesla, Apple, Amazon, invariably they're going to be attached to that position. They're going to know all of the talking points supporting that position going forward. Do you find it difficult to convince them
Oh,
this this, you might be wrong about this, or or simply we don't know. You might be right, but simply it's just the risk that you're taking here. I mean, how difficult is that in talking about a concentrated position
I
with
mean,
a
the
client?
odds that an individual stock will beat the S&P 500 in the next 12 months is about 1 in 3. So the odds are really, really against you, and it gets worse as time goes on. But that person that's showing up with that individual stock oftentimes worked at the company, right? So they're going, "Well, I know this company really well. It's always done right by me." Of course it has. That's why you're, in my office with this millions and millions of dollars of one stock, right? So it's wonderful that that worked out. It may or may not continue. And I don't try to talk people into or out of anything. I just walk them through, here's the probability of these outcomes. Here's the valuation of this position. Here's the amount of money you need to be independent for the rest of your life. And you know what most people decide to do is they take off the table what they need to be independent for the rest of their life, and they leave the rest in the game, and whatever happens. And 1 in 3 times, they're very happy that they did that. And 2 out of 3 times, they're very happy that they diversified.
That's often the answer. If you take something off and don't take everything off the table, then at least if it goes down, you feel good. If it goes up, you still have exposure, and that's usually the right answer for most people because the fear of missing out is just too much. They're thinking about, if I sell it all and this continues to go higher, that's absolutely going to kill me. But yes, very hard to convince people to change their minds, even when the evidence is staring them in the face. Okay, bias number 4, Dunning-Kruger effect. I know you don't have this problem, Peter, but a lot of people do. You overestimate your ability when you know little about something. And in the investing world, this is very common. And every study that's ever been done on individual investors, professional investors, what they show is when people are more confident in their abilities, they tend to trade more, and the more they trade, the worse they do. This is a famous study from Barber and Odine, and it's looking at 66,000 households, so not a small sample size. And what they found is the ones that traded the most had an annual return during this period of time of 11.4% of the year per year, and the market returned 17.9% during that period of time. So substantial underperformance and overconfidence confidence they found was explaining a lot of that, and their central message was trading is hazardous to your wealth. And how simple is that? That your confidence level in many areas of life, Peter, confidence serves you well. It's good to have confidence in your abilities when you actually have them. As we know, the randomness in investing and the difficulty in terms of getting in and out of the stock market makes overconfidence very dangerous. And you have an extra factor: the more confident you are, the more you tend to take concentrated positions, and you could just obviously do very well with that or do very badly with that, and more investors end up on the worst side when they take concentrated positions.
Yeah, there's definitely a curve when it comes to investing, as there is with just about anything you can become an expert in. Where if you know nothing, you go, okay, I don't know anything, and then you really research, and you feel like, let's say you're halfway there, you think you're 90% there, so you're taking very decisive action, but you're actually in worse shape than the person who knew nothing, right? And then there's someone who knows a lot, and that person who knows a lot is smart enough to know that they don't know everything that they need to know, right? And I think that that's a curve of knowledge. The more you know, the more you realize you don't know. And I think you take that, it can be a philosophical, if you're looking at religion, if you're looking at investing, it takes a lot to go from, I know nothing. Some of the best investors I know are the ones who go, I don't know anything, right? But I know, and I know these 2 or 3 basic principles: keep my taxes under control, be diverse. I think they tend to do better than the people that have probably spent 2 or 3 thousand hours researching the space, and they start to feel like they can outsmart certain segments of the market. You got to take another segment to realize that's not true, or very likely not
Yeah,
true.
and right, the chart here is kind of stunning because it's totally inverse correlation. You can see the net returns going down and the turnover going up. So just check yourself, check your ego. If you have an ego coming into investing and trading, it's going to be gone very soon because there's nothing more humbling than the markets. And this is a good lesson for everyone. I think that there was a famous quote right from The Big Short where it was something like it's what you think you know that, but it actually isn't true, that really kills you, and that's absolutely the case. Okay, bias number 5, the endowment effect, and we all do this. I think the study that that the famous study that they found out, it was, I think it was with Kahneman, and what they did was they gave people mugs, half the group mugs, the other half, they said, you didn't have the mugs, and they had people, you didn't own the mugs, but they had them then sell the mugs to each other, and the ones that had these coffee mugs, and they owned the mugs that were given to the mugs as opposed to just borrowed them, well, they demanded a much higher price when they were selling it. So they became attached to this thing right almost immediately. And so this is the concept: you value things much more when you own it. And I think the best example of this, and obviously this is true in the stock market, but the best example of this is the people's biggest asset for most people, which would be their house. And you see this all the time in terms of the houses that are sitting on the market. Well, it's sellers being unreasonable, thinking that their house, there's something special about their house that makes it worth more. They think it's worth more than it actually is.
Yeah, I mean, the endowment effect is why when you go in a jewelry store, they have you try it on, right? The second that the psychology switches to where you see that necklace on you, you see that bracelet, that ring, and that endowment effect starts to kick in. Oh, you like the car dealership? Why don't you have a seat in it? You like that dress? Why don't you try it on? And that's, people in sales are very familiar with the endowment effect and how powerful it can be.
Okay. Number 6, authority bias. You trust opinions from perceived authorities more. There's a lot of perceived authorities in the investing economics world. And I just picked out a few examples here from Treasury Secretary Yellen, former Fed chair as well, and some of her quotes and what she was saying about inflation in early 2021, downplaying inflation fears, saying they're small and manageable. This is kind of the transition. She expects high inflation rates to be temporary. Then she says they could reach 3% this year. Then she says it's going to stay higher for several months. And then she's saying this new bill that they wanted to pass is going to help with inflation. And then it ends, of course, with her saying we need to stop calling it transitory. And Yellen's not unique, but this is just a situation where the person who should know the most about a particular thing, this was her field of expertise, 100%, and she didn't see the biggest spike in inflation in 40 years coming. Not only did she not see it, one of the proximate causes of it, which was this huge borrowing and spending, the stimulus, she's saying that won't cause it.
Right, and
So what do you
what's
make of
crazy
this?
about this is it's not an exaggeration to say that this supply and demand function of money is literally week 1 of Econ 101. Do you know what I mean? This was not some advanced crazy concept, and so it just shows how powerful this is. I think this bias, it might have a different name when you put it this way, is when people look to it. It's not just being authority figure, but people look to authority even for things outside of their realm. Like when people are asking for the morning routine of Mark Cuban, who cares what it is? Like Warren Buffett's morning routine is to drink a 2 liter of Coke before noon, go to McDonald's and order bacon, egg, and cheese McMuffin. I mean, like that's not the person to get morning routine advice from, but we give all this, authoritative power to people who are successful in one area. I mean, look,
Yeah.
Janet Yellen can't get it right
I,
in her own area, right? And we look at people and we try to lean on them for advice outside of, like as if we emulate those things, we can replicate.
I should have put that one in there. That's the halo
Right.
effect. Yes. I love that one. I got to show one of these podcasts. We'll pull out Mark Wahlberg's
I know.
morning
I saw
routine.
that.
It's absolutely
Is it
hilarious.
2 a.m.
Okay.
or 3 a.m.?
Yeah.
That he's taking up like a
Yeah.
whole other
Something like
level from
that.
everybody else. Yeah.
Yeah. It's
And
like for like the whole entire day he's going back to the
yeah.
gym to
Uh, uh,
eating, back to the
Yeah, when I
gym.
saw his, at that point, you don't even get credit for getting up early because what you really just done is changed your entire everything's just moved. The entire
Right.
schedule calendar is just moved.
Yeah. It's pretty hilarious. If he actually did that even for one day, I got to give the guy credit. But Jerome Powell, similar. I don't want to just throw it all on Yellen here. This was him in early 2021. I really do not expect we'll be in a situation where inflation rises to troublesome levels. And he's talking about they're approving the third stimulus at the time, and he's kind of supporting it. And he's saying this is not a problem for this time, and the burst of new spending won't shouldn't cause unwanted inflation. And it's incredible how all of that is forgotten when today he's saying inflation is tame. We're going to get under control, and we're likely going to start cutting rates in the fall. Maybe that will happen, but it's all of the failed predictions of the past are just immediately forgotten. It's just kind of incredible when it comes to the Fed that there's kind of this the market and people. There's no remembering the past, whether it's Greenspan or Bernanke. Everything that they said in the past that didn't come true, we're still viewing them as oracles for the future.
Yeah.
Okay. Number 7, bandwagon effect. You tend to follow popular opinions or trends. Do you know where the bandwagon effect came from, Peter?
No,
It's actually a crazy
let's hear it.
story. I think it was in the 1800s. I think it was Zach Taylor running for president, and this popular clown at the time. It sounds kind of crazy that there was a popular clown in the 1840s that supported him and got him to ride on the bandwagon with him while he was traveling around. And that supposedly helped him get elected. And so then the opponents after that were saying, you're going to jump on the bandwagon. That became kind of a theme in the future. But we all tend to do this. You tend to follow popular opinions or trends because it feels good to be around other people and to think the same thing. It's much harder to be the contrarian in the group. And what's interesting about this bandwagon effect is that the normal relationship between price and quantity doesn't take hold with this bandwagon effect. What you see is actually more demand for it the higher the price. And there's a lot of good examples of, like, crypto is probably the best example where as soon as crypto's running up in price, you see everyone gets excited, everyone's excited, and then it crashes and everyone hates it.
Right.
Right? So a lot of different examples of the bandwagon effect in the market. I think today the easiest place for equity market investors would be the tech sector. How do you not jump on the bandwagon just given the enormous outperformance of tech versus the market over the last
Yeah,
decade?
you're talking about 13 years too. Like, it's very easy and to look historically at a chart and go, oh, tech bubble or 08, 09, I could have totally got through that. These are not things that go on for 3 weeks. I mean, this thing has been going on for 13 years. If you're a value investor, you've gotten destroyed by growth, small cap destroyed by large cap, every sector destroyed by tech. It's very hard to have the discipline and not take every single dollar you own and put it in large cap US tech because it's worked for 13 years. Of course, you know, people know that invest over long periods of time that that's not only not normal, it's never been sustainable, right? What we don't know is when is it going to end, right? So I look at creative planning, and our biggest position for almost every client is large cap US stocks. And so half of that is tech. So the huge beneficiaries of this run up, we don't know when it's going to end, right? Now, when it ends, there will likely be a rotation to something else. You will see things that underperformed do better. And those might be smaller positions in our client portfolios, but they're there, right? Whether it's small cap or mid cap or international or whatever. And so the hard part as an investor is to really, when you're looking every single day, thousands of days, to have the discipline to stay diversified. That's a very, very difficult thing.
Yeah, it's today like saying don't go all in on tech with, especially given that these are the names, and we've been talking about this for over a year now. These are companies you use every single day. I think that's what makes it so different than the past, even in the 1990s. Yeah, Cisco was a big stock, and yes, people use Microsoft, but the extent that Apple and Amazon and Google and Microsoft are in our lives today is just so much greater. So I think it's just that much harder for people to see a situation where they're not dominating. But history has taught us, right? The bandwagon can move in one direction, and then we saw how quickly after March 2000, it moved in the other direction. And that herd behavior, when it leaves, can happen very quickly. It doesn't have to happen the same way. It could be a decline that takes years to happen. But in this case, after 2000, it did not. People where everyone was in, and then all of a sudden the music stopped and everyone was out. And then nobody talked about tech. It's hard to imagine, but you're talking about 2002, 2003, 2004, 2005. Tech wasn't the big story back then, right? It was housing, it was energy stocks, materials, like it was new, different leaders. So this concept that it's always going to be technology, always and forever, simply isn't true, even just looking at the last 20 years.
That's right.
And we have the same thing, which is very interesting in terms of the people who give advice. These newsletters, and they tell you, dude, she should be long the market, short the market, somewhere in between. And Investors Intelligence tracks this over time, saying what percentage of these newsletters are bullish versus bearish. And today, the highest percentage of bulls we've had since 2021, 97th percentile, 63%. And you could see the relationship between the S&P 500 since October 2022, when the bear market bottomed, and this percentage of bulls. You could see it moving up, 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 right? So people now want to be bullish because prices are going up. The market's having an awesome year. We've hit 30 something all-time highs already. Who wants to stick their neck out and say that it's not going to continue? So we see this in the advice business as well. Hard not to fall prey to the bandwagon effect. Okay, number 8, and then we'll talk about some ways to avoid it. The recency effect. And this is probably the most perilous for investors because we tend to think that the recent past is going to continue in the future. It's just simply giving more weight to the latest information or experiences. And Vanguard does these polls of investors, Peter, every quarter, asking them, what do they think the stock market's going to do over the next 12 months? And I just highlighted in red here what investors were saying during bear markets. So in 2018, when we had the 20% drop, in 2020, when we had 30 something percent drop, and the high 20% drop in 2022, you could see investors were using that decline in the market, not to say that stocks were cheap or going to do better in the future. The exact opposite. They were forecasting that the market was going to actually do worse over the next year. And of course, the exact opposite occurred. And today, not surprising that people think that the next year is going to be good.
Yeah, I agree. I mean, it's very clear. It's like the University of Michigan Consumer Confidence Survey. Markets up, people are more confident. Markets down, people are less confident. They exit when it's down. They go in when it's high. It's the fear greed cycle over and over and over again.
And here we'll end with Kathy Wood. End of 2021 predicted 40% annualized returns for her fund over the subsequent 5 years. Here we are today. Since then, ARK is down 53% and change. In order to get that 40% annualized, you just got to do 167% annualized from here. Just a small tort. But I think the point, this is, talking about experts and relying on and the idea that you can know, and obviously that's 4 times what the market's return would do. Like that would be just incredible performance. But people were relying on. I actually spoke to someone in 2021 who was saying, this is a fund that did 100% in 2020. Even if it does half of that, even if it does 50% per year, that would be pretty good. And here she is making a case that that's actually possible.
Yeah, the tragedy of this fund is, and I don't, it's hard, you don't want to pile on, but the tragedy of this fund is that there were very few investors in it when it was going up a lot. And then it got all the attention because of the recency bias, right? And all the money poured into it to suffer the losses. We saw it with Legg Mason Value Fund too. We see it with the top hedge funds. There are very few people there in the beginning. When those returns happen, it then gets the attention. People expect that to continue. They go in and more people suffer. So the average investor actually does much worse than the returns you see historically for a fund.
Yeah, this fund almost has all of these behavioral
biases. In one fund, just package all of them, together.
If you wanted confirmation bias at the end of 2021, the fund was down, I think at that point already 50, 60%. Yeah. If you wanted to go out, she was out there for a couple of months talking about these 40, 50% returns. So it was pretty easy to find that confirmation. All right, Peter, what are some ways in your mind for investors to overcome some of these biases? Is there any practical tips that you can give people to say, you might not avoid it completely, but this will be helpful in following this path
What
instead of
I think
just,
the
yeah, just
the
accepting
first
it.
step is to don't start with the stock, start with you. Where are you? What are you trying to accomplish? To accomplish what you want to accomplish, how much should you have in stocks? How much should be in other asset classes? And then what kind of stocks or other asset classes should those be? Then you are not, what are you trying to do? Are you trying to make sure you're financially independent for the rest of your life? Or are you willing to lower your odds of being financially independent for the rest of your life to be potentially wealthier? Most people say, well, I want to be independent for the rest of my life. Well, now you start to move towards diversification. That gets you unmarried to a stock, more married to asset classes, and so on. You have a higher probability outcome. You're less likely to earn 80% in a year. But you're less likely to lose 80% in a year. You have to go through that series of decisions first. And for some people, it's, hey, I'm swinging for the fences, but just know what you're doing going in. Then don't get married to the stock. Ask yourself every day, would I buy this investment again? If I had cash, would I go buy this again? Again, the stock doesn't love you back. And look for the things that can go wrong. Don't just look for the things that will continue to go right. I'm sure you've got some
Yeah.
thoughts.
Yeah, my thoughts are that if you let subjectivity and you let your emotions drive things, you're going to fall prey to it 100% of the time. So the only way I think practically to avoid this stuff is to automate and just have a plan and outsource the rest whenever is possible. Because if you leave it to your own devices, you're going to do it because it's human behavior. You think you're not going to jump into that next trend, you're going to do it. You think you're not going to fall in love with the stock and stick with it when it's going down, you're going to do it. But if you have the discipline to say, this is my plan, this is what I'm doing automatically, this is my plan to rebalance when it hits certain levels, and I'm going to stick with it no matter what, well, then at least you have a chance. You might not, you might change your mind, but at least you have a fighting chance to overcome some of these things. I think beyond that, it's almost impossible. So there's 8 ways to do it, and I think it's helpful for a lot of people to get a second look and have an advisor, of course, looking at your portfolio to see if you're practicing some of these. I'm sure you are. So what we're doing right now for all Signal or Noise viewers, we're giving a free wealth path analysis. Take a look for a link in the show notes, and you're going to get a portfolio checkup with that. You're going to get a retirement roadmap. We're going to take a look at your tax situation. A lot of CPAs. We have estate planning attorneys that are going to look at your estate plans. So fill out the form. I'm going to have a link in the show notes for a call or a meeting. We're in all 50 states, 300 billion in assets under management and advisement, and we're here to help. So definitely check out that offer, free wealth path analysis. All right, number 2 here, Peter, 401k contribution nudge. This has been enormous. We're going to talk about biases. We have a huge bias that we didn't talk about, which is simply inertia. And that inertia is if the employer is not automatically signing, first of all, people up to that plan, a lot of people won't take the effort of signing up to it. But then one step further, whatever the employer sets as the initial mark of they're going to save 2%, 3%, 6%, whatever that is, people often stick with that and then don't change that. So the fascinating thing, and this is, in my opinion, an awesome development, is a lot more employees are raising that level of what they start out with in terms of automatically taking saving for their employees. And they're, instead of 3%, they're moving up to 6%. You can see this chart right here, the decline and the plans that enroll workers at 3% and the increase in 6%, it's more than doubled. I think it was 15% a decade ago. Now 30% of plans are doing this 6% automatic enrollment. What do you make of this? I just, in my mind, it's just a huge positive development because what they're saying, Peter, is people are not going then in overriding it and changing it. They're actually sticking with it for the
Yeah, I
duration.
think just not only was auto enroll a brilliant idea of just automatically, hey, automatically we're going to put money in here and you have to opt out, but also the idea of the automatic increases, where over time the contribution just goes
Mm.
up. I think this by itself is making hundreds of thousands, if not millions, of people financially independent that otherwise would not have proactively taken these steps. I think it's fantastic.
Awesome. Yeah. So here's some of the data on this. About 60% of companies now automatically enroll new hires, and that brings the 401k participation rate up to 82% of eligible workers. In 2007, it was just 66%. And here's an awesome stat. Last year, the average employee with 401k account at Vanguard saved 11.7% of their pay, an all-time high. And what's the big reason here? It's down below here. People tend to take the path of least resistance. So this nudge, this automatic enrollment, people are just going to stick with it because we don't change
Yeah.
things for better or worse. And here it's for better. And so any people out there with 401k plan, if you don't have this, obviously make sure you're saving the amount that you want to save. But if you do have it, good for your employer. That's a great thing. And make sure, as always, Peter, that we say number one thing, make sure you're trying to save as much as the company match, because that's just free money that you're leaving on the table if you don't do that. All right, we're going to end, Peter, with signal or noise here. This is the hot topic of today: growth versus value. Highest ratio since March 2000. What happened in March 2000? Oh, nothing big. That was just the peak of the dot-com bubble. No big deal. What do you make of this chart here? This is almost 3 standard deviations above the mean. We have data on Russell 1000 growth and value going back to the 1970s, almost 3 standard deviations above. There's really only one comp left in terms of growth's outperformance versus value, and that would be the dot-com bubble
Yeah,
peak.
I think that 100 years from now, when you're looking back at the markets, and there's going to be this 5 to 10 year period that just doesn't make sense with everything: small versus large, U.S. versus foreign, growth versus value, and there's going to have to be an asterisk that says there were about 5 to 10 tech companies that changed all of this, right? So I would add that as the caveat here that makes it a little different. It's not quite as widespread. It's just really the emergence of the mega cap tech company, and you see it like it continues to be sustainable because the same companies have been so good at adapting. The 4 or 5 leaders in the AI revolution, most of them, not all of them, most of them are the old legacy names. Yeah, you have Nvidia, but you also still have Alphabet and Meta and Google and Microsoft. These are the leaders in the AI space. So you see this whole new revolution happening within these companies. But look, we know this how this story ends. There will be a regression at some point. It can happen. It doesn't have to be a collapse of growth. It can be a slowing of growth and an increase in value. But one way or another, we know the end of this movie, what it's going to be like.
So you're saying signal here?
I think that's a signal. It's. I think it's mostly noise with a signal embedded in it. It's not 100% noise. I'm curious your take.
All right. I'm not going to equivocate. I'm going to say this is signal
Okay.
here. I'm going to go out on a limb. We don't do many signals, but I think this is one. This is what happened the last time we were at these levels, 7 years following that peak in the growth to value ratio. 85% return for Russell 1000 value over the next 7 years. Russell 1000 growth down 29%. Don't expect the same thing to happen in the next 7 years. And like you said, it doesn't have to be a crash in this ratio like it was the last time. We went from way above it, you could see in the chart, to way below it. Right? We don't have to do that. We could go back to the mean. We could just trade sideways. But the point is, I don't think investor expectations saying growth is going to have the same returns in the next 10 years that it had in the last 10. I don't think that's realistic or reasonable. I would not be this is the worst time, I think, to throw value stocks out of your portfolio. And I think you'll be happy to have it at some point in the next few years. Even if we just go sideways back and forth, at least you'll have it during years where there's big growth outperformance. So my take, we'll revisit this in the future to see if it was actually a signal. But I'm saying this is a signal. Doesn't mean it's going to happen tomorrow, but at some point, you'll be happy to have something other than the Magnificent Seven growth names in your portfolio. Okay, Peter, covered a lot of ground. We'll end it right there. If you're watching this on YouTube, hit that subscribe button, hit that like up button, leave a comment, read all of the comments, try to respond to as many as possible. Thanks, everyone, for joining us, and we'll see you next time on Signal or Noise.